We think women need to talk more openly about money because money really matters. It shouldn't be embarrassing or confusing. Join the conversation. We'll be discussing a whole range of topics which will help you get comfortable with your finances. Money Matters, brought to you by AJ Bell.
Hello and welcome back to the AJ Bell Money Matters podcast. I'm Danni and I'm delighted to introduce another member of our growing Money Matters team, Sarah Cole. Hi, Sarah.
Hi, Danni.
Since you are new to the pod, it is a perfect time to remind listeners of what we're all about. And that is to help more women feel good about their finances, to have a safe space to ask questions, to bust some myths, to ditch the jargon, and just have some really simple conversations about money, the things that affect you, future you, and your standard of living. And it's not about dumbing down, it is about lifting up and helping women feel more confident about making money choices. And I know that is something that you've been passionate about for a long time, Sarah.
Yes, it's been a fairly long-term obsession. I think it comes from the fact I've had a fairly lumpy life, which I think a lot of women will be quite familiar with. So I've been through things like single parenting. I worked for myself for about 10 years, and then I was caring for an elderly parent, went through bereavement, all those things. And really financially, I've only got through it in one piece by kind of knowing enough to make those tough kind of financial choices, and also to kind of keep one eye on what's coming next, and so that you're not constantly spending life on the back foot dealing with whatever drama life throws your way, but actually getting ahead and planning. And so I'm really passionate about giving people that sort of confidence and the understanding, so that it sort of helps them through these pretty tough things that life tends to throw at us.
I love that term, a lumpy life. I think we can all get behind that term, because when we talk about women's lives, that they're not a straight line. There are lots of twists and turns and as you say, difficult choices. But the fact that you had that knowledge, I guess, has just really helped you on your journey.
Yes, definitely. And it's also, I think, when you realize that you're facing something tough and knowing you've got to make a choice, I think that we are sort of all pre-programmed to try and make do and muddle through and sort things out. And there are times in my life where I've had to stop and ask for help and ask people how things work, and really reach out to other people. And I think that's a really big part of it as well, kind of getting that confidence to think it's fine. Nobody's taught us this stuff. We do need to ask.
Yeah, I mean, regular listeners will know that my life has been far from smooth. And until I started working in the finance sector, my knowledge of finance was pretty, well, non-existent, really. And I went into having kids without making choices about what my husband and I were going to do with our finances. And we've been through periods of unemployment and that kind of thing, like many listeners will have been through. And it has been tough. But the one thing that I have learned by doing this is there are people to talk to out there. There are resources out there that you can access. And that is one of the reasons that we started Money Matters in the first place, was to try and create a real hub where you can find bits and pieces of information that might be able to help you make the choices wherever you're at. So if you go onto the main AJ Bell website now, we have our Women and Investing Hub. That's where our Money Matters content can be found. And we've got all sorts on there, from getting started investing, things like how to reach your money goals. And everybody's money goal is going to be different depending on their financial situation, their time of life, their family, that kind of thing. And we also know, of course, that it can be really hard to find even a spare pound at the minute, because the cost of living just seems to get more and more expensive. And this week, I wanted to get you on the pod, and I wanted to talk about how some of the things that are happening around the world are having a huge impact on our financial lives. And we've just had the energy price cap announced this week, and no surprises, it went up once again. I think when anything comes down now, we just sort of want to do a bit of a celebratory dance, because it seems to happen so rarely. And we've also got lots of talk now about the potential of interest rate rises because of the war in Iran. So we really just wanted to spend this episode just talking through why something that happens half a world away, or why something that's happening in politics has an impact on our domestic financial lives. And it was really interesting because I've got a group of mum friends that I see every couple of months. We get together and we go to someone's house and we drink far too much wine and we talk about just about everything. And for the last couple of times, it's been about money and it's been about prices rising and lots of questions about, why, because the local elections went one way, are we suddenly talking about borrowing costs going up? And why, because we've got a war in Iran, are we talking about interest rates going up? Is that the sort of thing that your friends are talking about now as well?
Yes, I mean I guess the filling up the car has been like the main thing that people have noticed. I think also there's real worry about food. I think for those of us who've got teenagers in particular, I'm going to go out on a limb here, particularly teenage boys. The food that they get through is unbelievable. So I'm buying about half of Tesco on a regular basis, and I'm getting to the point now where I think I may as well just hand them half my salary and then just be done with it.
Food is, I've got two teenage daughters, as you guys all know, and one of them is at university. So from time to time, I get these begging texts. I've got no money for food. Can you send me a Tesco shop? But my youngest is at home at the moment doing her A levels, and I think she's got hollow legs because the fridge just seems to be constantly open. And I'm just yelling at her when that beep goes off and she's sort of staring into it. And I'm thinking, nothing is magically going to appear because the amount I'm shelling out every week just seems to go up and up and up.
Yeah, is that we've got nothing in the house, and you think apart from all of this food you don't want.
And that food prices is something I spend quite a lot of time talking about at the moment. But you're right, the oil price. I think every time I speak on the radio at the moment, the first thing I get asked is, what's the oil price doing today? It's become just one of those bits of data that we are absolutely obsessed by. And I wanted to talk about why the price of a barrel of Brent crude, which is a type of oil, there are lots of different types, but Brent crude is sort of seen as the one that we measure everything against. So if you're hearing that, that's what that is about. But why, when a barrel of oil goes up, particularly as it has been over $100 a barrel, it then has this huge effect on the price at the pump and also everything else as well. And we know from our last brush with energy prices going up that it's not just petrol prices that go up. It's not just the obvious things, gas and electric prices that go up, but it's also food, because you've got to think about the fertilizer that goes on the land. You've got to think about the tractors ploughing the fields and putting the seeds in. You've also got to think about then, those being harvested and transported and then turned into other stuff, which are then wrapped and then transported again, and they're kept on a cold shelf in a supermarket somewhere, which all costs energy. And all of those things sort of snowball together into one great big thing. And as the snowball sort of starts at the top of the hill, it just seems to get bigger and bigger and bigger as it goes down the hill. And suddenly one price going up means that all the other prices are going up as well. And they seem to go up really fast, but then they don't seem to fall back in quite the same way. And I was taking a look at a report by the Energy and Climate Intelligence Unit, which came out earlier this week, and it was talking about rocket and feather price rises versus price cuts. And you might have heard people talking about this when it comes to petrol prices before, but certainly the price hikes that we've seen, which came in 2022, 2023, they've not all gone away. In fact, most of them haven't gone away.
Yes, and it's actually one of those things that it's quite hard to keep an eye on. I think because you go into the supermarket and you're buying sort of 50 things, well, I am anyway, you don't really notice when one of those prices rises. So I think it's actually a really good idea to keep your receipt, because that's really the only way that you're going to know what you paid for something last week, and then compare it to what it is this week, and to see whether actually is this something that we still need to buy? Is this something where I can trade down or I can buy an alternative? And it's really only that way that you can keep an eye on it. Otherwise, you're going to get to that till, and then you're going to get the nasty shock at that point. And when it's at that point, you're having to start put stuff back, which is always quite embarrassing.
Olive oil was the thing for me, and that was not all to do with energy. We talk about energy, we talk about Russia's invasion of Ukraine, which did have a huge impact on food prices and all sorts of other prices, energy prices. But we also have climate issues as well. And here in the UK, I know that over the last 5 years, we've had 3 of the worst UK harvests on record. We've got drought. We're just in the middle of a heat wave, and you can imagine how that is then going to impact the kind of yields that we see from the UK. And olive oil, it became almost a luxury item, and I'm just sticking it in my spag bowl.
I think it's the same thing happened with chocolate. We had that horrible moment when the harvest was in trouble, and yes, that became really expensive. I think one of the harvests that people forget about is grass, because they don't really think about it as a crop. Whereas actually, it's really important how the grass is growing and how the nutrients in the grass grow. Because if it's not strong enough, then farmers who are producing milk need to pay for feed, and that then feeds into the prices again. So, when you're walking out and you're seeing the grass start to turn brown, it doesn't just affect how beautiful the landscape is; it also affects your prices at the supermarket.
My dad was a farmer, and so we lived in a farming community when I was a kid. And yeah, absolutely. If you had a period of really wet weather where the fields were really boggy and crops were just rotting in the soil, or you had a period of really dry weather, then all of his neighbors would just they'd be gathered around on tractors, scratching their heads and just talking about the impact that it was going to have on their businesses in the months to come. And I suppose when you're down at the local supermarket, you're not really thinking about that. You're just thinking about the fact that stuff's costing more.
Yeah, you're right. There's so many different things that affect the price of food, which is why things like food and energy, the prices there are often quite volatile, which sort of means they go up and down a lot. And that's why when we talk about the inflation data, we often look at what's called core inflation, which actually strips out those food and fuel costs, those sort of up and down things. And that's something that Bank of England takes a good look at when it makes its interest rate decisions, because it's obviously going to sort of not then be swayed by a sudden rise or a fall in those particular areas. So obviously we're going to talk more about that in a moment with our special guest. But we've spoken about food, but I wanted to drill down into energy a little bit, because our last set of inflation data, which gave us an insight into how quickly prices were rising in April, so that actually went down. So despite all the doom and gloom and how painful everything has felt generally over the period of time, it actually fell from 3.3% to 2.8%. And that's because the energy price cap fell at the start of April. And that offset some other increases like those higher petrol prices we're talking about. Now, some of that was down to wholesale prices falling at the time the cap was being set, but some of it was actually also down to government policy. So the government decided to take the cost of renewables off energy bills and put them into general taxation, so that that effect wasn't directly felt on the cost of energy.
And of course, good news, as it always seems to, only last for so long. And since I am always bringing you bad news, I thought I would continue that trend. And here we go. The new energy price cap, which will come in on the 1st of July, will go up by 13% or £18 a month. Now, that is dual fuel, that is average gas and electricity use, because the cap actually sets the maximum price that you can be charged per gas and electricity unit. I'm sort of giving those caveats because sometimes people can hear the headline figure and think, well, hang on, I'm paying more or less than that. But it is about average energy use. And I think one of the really interesting things with this price cap is that if you're seeing a figure somewhere which is talking about £1,663, the amount that your average person is going to pay per year, and you're thinking, well, hang on a second, it was £1,641 in April. So that's not come down by anywhere near, not going up by anywhere near as much. But that's because we've changed our habits. We're using less energy, and it means that Ofgem, who sets the price cap, and they do it 4 times a year now, they are calculating things a bit differently. So I think if you're seeing any of those figures, just bear in mind that it's about £18 a month more that you are going to be paying. But of course, we're always looking back, aren't we? And when we're talking about inflation, you were just saying that for April, that the number had come down, but we're already, the end of May. And we've already experienced April, we've experienced May, we're already thinking about the autumn and the winter. And when we are thinking about what we're putting in our basket at the supermarket, that's our day-to-day inflation experience. And it's interesting because when the Office for National Statistics, which produces this overall inflation rate, the CPI rate is one that you might have heard used, Consumer Prices Index. They use a basket of goods, and that basket is changing all the time. There's all sorts of stuff in it, like, a plane ticket. You can't fit an airplane in your basket, but you can stick a plane ticket in there. And it changes all the time. And hummus went in this time, which I was really interested in. But if you think back to COVID, we had hand sanitizer that was in for a little while. So it's a really interesting look back at our habits. If you ever, have a spare moment to pore over Office for National Statistics data, which is something I get excited by. But, there we go.
I'm always very excited about, because they sort of randomly pick items to kind of represent a bigger category of items. So petflation has been like a really huge issue. So they've decided to just pick a small pet. So they picked a hamster. So there is a hamster in the basket, which I love. There's also things like door handles, there's caravans, and there's loads of things that you think, I can't remember the last time I bought a hamster or a caravan, but it's all obviously just all representative, and then it just feeds into the basket to show how generally prices are rising.
And let's just explain how inflation works, because we've been talking about CPI, we've been talking about Bank of England, we've been talking about how prices go up, but just explain how it works.
Yeah, sure. So inflation isn't something that we're sort of born with a natural understanding of. So you're right, we do need to go through it. So if you were imagining that, say, inflation was 2%, so it would really just fundamentally mean that something that cost £1 a year ago would cost £1.02 today. So we tend to talk about inflation in the sort of the negative side of things. So we worry about high inflation, but actually a little bit of inflation is a pretty good thing. So it kind of helps keep the economy ticking along. Because if you think about it, if prices stopped rising, then everybody would sort of hang on thinking, well, maybe they'll get cheaper, so I'll put off buying them, and then maybe they'll come down later. And then you get quite a lot of stagnation in the economy. And it also means a bit of inflation means businesses are earning a bit more. So they can take on a few more people, and they give people a few more pay rises. And so that kind of helps growth in that side of things too. But then again, you're looking for that Goldilocks. You want a little bit, but you don't want too much. Because if, as we've discovered and discussed quite a lot, if prices are rising really fast, it does make life very hard.
And when we are talking about prices and what makes up inflation, a lot of prices are actually set globally. So if you think about, we were talking about Brent crude, we were talking about oil at the beginning, energy prices. Well, those things are set globally, and a lot of goods are imported. So then, of course, you've got to think about the increased costs of shipping. We've been hearing a lot about the blockade in the Strait of Hormuz, when tankers can't move, or the insurance is going up, the costs of shipping are going up. Then all the stuff that is either stuck on there is not able to get where it needs to go, and that means somebody else is trying to get more from somewhere else, and maybe they're going to pay more for it. But then generally shipping costs more, and as I was saying earlier, it's just a snowball. So when people start saying, why are you talking about something which is happening half a world away, having an impact on the prices that I'm paying here at my house in Huddersfield? That is why.
And I kind of to make matters worse, you've got kind of domestic policies kind of filtering into that as well. So we've just talked about that government policy on renewables having an impact on energy prices, which has sort of helped bring those energy prices down. But also taxes can make things more expensive. And then tariffs, which are a kind of tax, also make things pricier. So one of the reasons the Chancellor's just announced she's getting rid of a whole load of tariffs on things like baked beans and chocolate is to try and help keep food prices from rising too much in the next few months. And there's a real hope that those things will get passed on at the supermarket and help us save some money.
And inflation is important, as we said, when it comes to how much we pay to borrow money. The Bank of England actually has a job to do to keep inflation in check. You said that Goldilocks bit, that sweet spot, which is often considered to be around 2%. And it uses interest rates to try and maintain that balance. So if it puts up interest rates, then that means that people are probably going to borrow less. Prices are becoming more expensive. So maybe they decide that they're not going to pay that price. And then hopefully the prices then come down, because a lovely phrase that I hear all the time and I really like is the best cure for high prices is high prices themselves. Because you get to a certain point, you say, I'm not paying that, or you trade down, and it does then have a knock on. But you've also got secondary effects. So you were talking about employment as one of the things that the Bank of England looks at when it makes its decision. Well, we also have a situation where if people have got high inflation, then they're more likely to go to their employer and say, hang on a second, I'm really struggling. So could you please pay me a little bit more so that I can pay for the chocolate bar, which is now costing a ridiculous amount of money because I just love chocolate. And your employer might say, actually, yes, because I'm now able to charge my customers more for those things. So I will pay you a little bit more also because I really want to keep you. And there aren't that many people around to do your job. But when that changes, and there are a lot more people now than there were just a few years ago who are unemployed, then the ability of these businesses to give you big pay increases, it's not as easy. And that's one of the reasons why the Bank of England and a lot of the members of the Monetary Policy Committee have been saying that they don't expect inflation to be the same as it was the last time we went through it just a couple of years ago. And that is because they don't expect that we'll see quite the same level of that secondary effect. We won't see quite the same level of pay increases, which is disappointing. And I know a lot of people say, yeah, but if prices are rising, we want pay increases. But, pay increases then keep prices higher for longer.
Yes, it's one of those things that makes most people very unhappy, but actually makes economists very happy. But there is, I think there's sort of the concern about inflation rising. So there is talk about maybe it's going to get to sort of 5% or even 6%. And it does mean that it's affected that Bank of England decisions, and the fact that it's stayed firm at 3.75% and actually not moved at all this year, even though there was so much talk about the fact that at the beginning of the year, people were expecting those rates to be cut. And of course, now there's a growing expectation that instead of falling, the next move might actually be up.
To dig into what all of this might mean for all of us, I am delighted to introduce our special guest for this episode. Rachel Springall is from MoneyFacts. Hi, Rachel.
Hi, Danni.
First of all, just tell us what MoneyFacts is and where people can find it.
Sure. So people might have heard about MoneyFacts. We are a UK data provider, which means we collect lots of information on mortgages, savings, credit cards and loans. We're actually one of the biggest of suppliers, and we've been going for over 35 years. And that actually means that because of all the information that we have for people to get their teeth into, we also have a comparison site, which is free to use for consumers. So that's really handy for people where they can go to moneyfactscompare.co.uk and check out the latest rates for free.
And that is for things like savings rates and mortgages and credit cards and that kind of stuff.
Yeah, so lots of different things that you might kind of think, oh, I'm not quite sure where to go to find a mortgage. I'm not quite sure where to go to look at savings rates or a card. That's all in one place. So it's quite handy for people just generally shopping around and trying to get abreast of what's out there.
Okay, that's the introductions done. Let's get into the meat of this thing. And I wanted to start with the Bank of England's base rate, how it's used, because some people get really confused that it's not the default setting for things like mortgages and savings interest rates.
Yes. So in our country, most people actually fix into their mortgages. So a base rate change doesn't really affect them. And actually, base rate doesn't intrinsically link to fixed rate mortgages at all. So when base rate goes, it more impacts people on a variable rate deal. And even then, only really if they're linked to the Bank of England base rate do they then see an immediate change.
So what do we tend to see happen when the Bank of England changes rates? So let's say it raises rates. What will usually happen to things like mortgages and savings?
So they're quite influential. So I would say rather than a direct link, they're influential. They can make banks and build sites change their rates. But also what happens with base rate is sometimes it's not even the fact that they change. Sometimes it's the expectation that they might change that actually feeds into the market. So for savers, rates going up is a really good thing, but there's absolutely no guarantee that your rates go up with base rate unless you're linked to it, like literally with your product, and it follows that base rate.
So you talk about expectations. I think one of the things people tend to hear about when there are these sort of talk of expectations is swap rates. So at the risk of asking what is essentially an A-level question, can you explain a little bit about what swap rates are and why they matter?
Yeah, swap rates are the bear and brunt of mortgage customers, unfortunately, and they can seem quite complicated. So they are an agreement between lenders and investors. So when swap rates go up, it's the future expectations for interest rates to go up. And that's actually what impacts current pricing for the future. So say you lock into a deal for 2 and 5 years, that bank or building site needs to know what rates might be in 2 to 5 years to ensure that they're not locking you in on a really low rate. That's bad for business. So really, that's something that all those banks and building sites need to consider. So even though nothing changes with the Bank of England base rate, you can start seeing interest rates go up if other influences are affecting the swap rate market.
And other influences might be government borrowing costs. We've had a lot of political uncertainty in the past few months, a bad election result for Labour in the local elections. We've got a by-election coming up, which could see Andy Burnham return to Parliament, potentially a new Prime Minister by the autumn. So when government borrowing costs go up, does that also factor into what's going on with the rates that you and I are interacting with?
Yeah, unfortunately, what we see is the overall view of the UK gets impacted by, unfortunately, a creation, a pot of many things. So when we talk about borrowing costs, we're talking about interest rates paid on national debt. Two quick ways to get money in to actually pay for public spending is one, to get loans and to pay interest back on those borrowed loans. This is the government borrowing. And the second thing is to raise taxes. So if you're not going to do the latter, you need to borrow money from somewhere, and then that helps you fund public spending. Unfortunately, what we've had is a domino effect of many things happening. Some of it is out of our control, like the global changes, and also, say, politically unrest with where that's going to go. And all of those things affect what we call gilts. And the gilts is the borrowing costs that we're talking about. So when you hear all this news about gilt yields rising, that actually is a big uncertain red flag. And we start seeing interest rates go up. We start seeing concerns over public spending, recession, and all of those things is really bad news for anyone looking into our country, wanting to invest in us, wanting to lend that money in.
And a fun fact that I discovered was that all this is done on computers these days. You're not handed bits of paper, but you used to be handed a bit of paper, and those gilts had a gilt edge, which is why in the UK they're called gilts rather than something else like in the US Treasuries. So there you are. That's another bit of A-level work for you there. We're providing textbooks and all sorts of stuff. There are lots of moving parts. It is complicated, but as we said earlier, whoever becomes prime minister, is prime minister, stays in office, however many years we're talking about, rising prices could well mean that the next move on interest rates, on that base rate from the Bank of England we were talking about, is up and not down as we'd hoped.
Yeah, so inflation is probably the primary thing that the Monetary Policy Committee at the Bank then look at for changing interest rates. But all the communications that we've had over recent months, and I will say recent months, as in the last 3 months since the unrest in the Middle East really began, is that they don't want to make quick, sudden decisions. But what that can then mean eventually is that we get a larger base rate increase to compensate for the time that we've waited for interest rates to rise to try and combat inflation. But what I would say with base rate is it doesn't just change because of inflation. There's other things the MPC look at, like they look at unemployment, they look at how the country is doing as a whole. So unfortunately for you and I, anything that is expected to change can already affect interest rates in terms of savings mortgages, as I said. But for the Bank of England, they're kind of sitting on the fence at the moment, let's be honest, as to what they want to do. So really, for people who have perhaps a pot, like a savings pot, that money might not actually be worth very much in months to come if inflation starts going crazy because of primarily the energy problems we're going to be going into that we're already, kind of aware of. That's coming, and that's not great for people trying to, earn the best off their savings. So, really maybe think about investing.
But I mean, when we sort of you kind of get the tone change that happens over time. So we went from a period, if you can cast your mind back all the way to the beginning of the year, where there was lots of talk about, well, the next Bank of England move is going to be down, and now there's sort of talk about the next one's going to be up. I think it is worth kind of putting it in a little bit of context, because I think when we talk about interest rates, it's easy for us to look back at sort of recent history. So at the moment we're on 3.75%, and really that's actually historically quite low. But what we are looking back to is we're remembering those sort of ultra low rates that were around really in the wake of the financial crisis up until basically 2022. They were less than 1%. So that actually became what felt normal. So it does mean that now we're seeing these sort of talk about rates rising and these sort of slightly higher than 1%. We get a lot of that feeling that actually, gosh, aren't mortgages getting really expensive? And, and I suppose on the flip side, the thing for savers, that they're sort of finally feeling that after that sort of 20 years of pretty rotten returns on their savings, they're actually doing a lot better.
I totally agree. Unfortunately, what we've had, even as you say, looking back just perhaps the last 10 years, we still have painfully low interest rates. I had a little look at some interest rates recently, and if we were to kind of get an average sense of what someone would earn on quick, easy access money on a cash account, it's about 1.5% over the last 10 years. And that's around half of what inflation's been going up by on an annual basis. So it just shows you immediately that your real money isn't actually worth what it was worth. So when you've got the government obviously trying to push people to invest more, that's a very clear look, this is actually what happens to your money if you don't have the highest rates or if you don't think about investing in the long term, because inflation is a huge problem for people. It's unfortunate that a lot of people don't think of inflation perhaps on their savings. They think more about groceries and general expenditure, but it's about the overall spending power of the money. And that's why inflation is really important to try and fight, whether that be again for investing or perhaps fixing your money in your account and get a guaranteed return. But even so, I think this country as a culture, unfortunately, is very short term when it comes to our savings and our mortgages. Our mortgages are 2 or 5 years. I think about 95% of mortgages in this country are like up to 5 years. That's it. Everything above that is very niche and not many people go for it, because it's just not what we do in the UK. A lot of other countries do. They have 10-year plus mortgages. So they don't get impacted when we have global change that messes up our swap rate markets and causes mortgage rates to increase. And also savers, they don't immediately benefit from anything like this either, because again, in our country, a lot of people want to have access to cash. And unfortunately, those rates are pretty poor, particularly if they're just left in a bank account.
I think when you lock in for a long period like that, some people feel out of control, and actually it's creating more control, but we just don't discuss it like that, do we? I mean, I remember actually having one of those 5-year fixes for the first time. I've only ever had one. The rest of the time have been 2 years. And it just gave me such a huge amount of breathing space when things started to change drastically. Look, thanks so much for joining us on this episode. Before I let you go, though, it is time for another 2-for-1 special. I'm liking this because I get to ask you both to dish up your financial confession or dilemma. Guess first, Rachel, what's yours?
Okay, I had a really good think about this. And the one thing that I didn't really do until recent years, and it sounds really silly, I didn't automize my savings. And what that meant was when I got paid, everything I needed to pay got paid. But my savings, I was waiting till the end of the month to see what I had left over. Now I'm a very big advocate of paying yourself first. It has helped no end to set yourself up a weekly automized thing or a weekly reminder to put a little bit of money aside. And that's really helped over the last few years for like doing some houseworks and bits and bobs. So I would say that. And the second thing I really want to do, and this is again another confession, is that I don't automatically invest. And that's something I do want to kind of sort out over the next year or so, hopefully, fingers crossed.
I love that. I'm a big fan of automation because if you don't see it in your account, you kind of don't miss it when it's gone. And yeah, pay yourself first. That is a great confession. Sarah, what about you?
So I've gone for a dilemma because there is a dilemma that's really forefront of my mind a lot at the moment. And this is how much support that we should offer our teenage children. So I know a lot of parents will think of it as sort of the amount of support that they got back in the day, you know, when maybe they were on a, YTS scheme and paying their parents rent and expected to move out straight away after they'd finished studying and all those things. And there's a sort of a feeling of why don't we expect the teenagers of today to do it? So there's lots of sort of questions around if you want to help support your teenagers, whether or not that's the right thing to do. My personal feeling is that the scale of the challenge is just so much worse now. So we've got all these, let's talk about changing the economy that's making it really difficult to get entry-level jobs. And I know from my own experience, there's lots of graduates who are going for jobs that are now that you don't require a degree purely because they can't find graduate jobs. So then those people who might be going for those jobs are getting them taken by graduates. So there's a sort of a terrible kind of circle of not being able to get a job that really is kicking in. And I think at the same time, there's sort of weird social media effect that where people think that they have to have all of their life sorted. It can actually have a really horrible effect on their mental health, that they feel that they're letting themselves down and they're not sort of maximizing themselves, which is what everyone goes on about on social media. And then, of course, you've got the other side of things, which is the sort of the house prices and the rental costs and how hard it is to actually move out. So interestingly, it's not something my husband or I actually are on the same page yet with. So it does mean we're going to have an interesting few years of discussing things before things come to a crunch.
I feel you there because my kids are at a similar stage, and yeah, it's hard because you want to give them the absolute best start in life that you can, but also it comes to a point where you go, well, they're going off on holiday to Greece, and when was the last time we went away? Oh, it's because we're busy paying rent.
I think it's that fear of missing out, isn't it? That's just everywhere these days. Like, oh, I want to do that thing I saw on Insta. And it's like, but again, like, you only say you're young once. And, I do remember in my early 20s, like, I was getting married and getting a house. And then now I see, like, early 20-year-olds like, well, that's never going to happen. I'm like, but you can if you save.
I think it's a really tricky one. I think there is that feeling that you want to help, but you think, when is that ever going to stop? Will the bank of mum and dad just be open for life?
Become the bank of mum and granddad and great granddad.
No, I'm drawing the line there. Look, Rachel, thank you so much for your time today.
Thank you so much for having me. It's been wonderful. Hope to come again.
And Sarah, thank you as well.
That's great. Well, I've enjoyed it. I am looking forward to the next one.
And don't forget, for all of you, if you haven't signed up to our newsletter, you can do so via the Women and Investing Hub. We'll keep you up to date on all the great content that we have available or coming up, the next pods that we've got. And you can also find us on social media. We are at AJ Bell Money Matters on LinkedIn, Instagram, and Facebook. And thanks so much for listening.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.